Welcome to another roundtable. My name is Adam. I have Rusmin.
Hello.
And Victor.
Hi everyone.
Thank you for joining us. And today we're going to talk about China. So maybe not the most popular stock market for a lot of people, but there's been recent bad news about China and its economy and what's happening over there. So we're going to share what's happening, in China. But then we want to explore, because of what's happening in China, there could be an opportunity in the Hong Kong stock market. All right. So we're going to discuss that as well. So before we jump into the companies and stocks we could be looking at, what's happening in China?
I think if you have been reading the news in the month of August or even July, there's been a lot of bad news about China economic recovery, right? So starting from the industrial output, it's actually quite weak in the month of July. And of course, the retail sales are also quite weak. But basically, generally, the GDPs, or what people expect China to come out from COVID lockdown, or it's been below expectation. Okay, so that has kind of weakens the stock market, and things just got worse when Country Garden, one of the largest developer in China, actually missed the bonds payment. Okay, so that caused another fear, a huge fear, or trigger a huge fear across the market, because we had this discussion I think a couple of years back when we talked about China Evergrande, right? And now people are talking about another lemon moment, right? So in China, okay, because this Country Garden missed the bond payment and charges are high that they might default on that, okay, because of the weak property market in China, okay. So and also there are also a lot of state-owned developers. The few of them, I think 18, actually have also warned that in the first half of this year they might reported losses, okay, because of the weak property market condition. Actually, if you look at the new home sales in China by the top 100 developers, actually has been coming down. And even the prices for home in China also has come down. It dropped, I think, about close to low single digit. Okay, that's enough to trigger the fear. Okay, and recently also we saw China Evergrande file for chapter, not 11 but 15. Okay, so basically they are still running. It's just that they just make sure they file for chapter 15 so that they can continue to run the business, and then meanwhile restructure the bonds with their creditors, right? So I think this property crisis in China it has come back again, okay, since 2 years ago, right? And it seems like the property crisis are spreading across other industry, and one of it is actually got affected is the what they call it a shadow banking part of China, which is the wealth management company. Okay, so this company called Zhongrong, right? So they are one of the largest fund managers in China. Okay, so they basically sell investment products to Chinese investors, right? Or if you are a listed company, you can buy investment product from them, and then they will guarantee you, promise you a yield, right? And then they will subsequently take your money, and then they will lend it to some of the property developers, right? So that could spill over to this asset manager in China, and they miss the bond payments that the investment product that they sold to their clients, right? So there was some protest, wasn't as bad as compared to the one that we saw with China Evergrande, right? So so this wave of bad news actually caused a lot of foreign investors to flee the Chinese market.
And I think it got even worse when I think recently you can see articles like Straits Times say that global funds abandoned China blue chips in a 12.6 billion sell-off, right? But if you were to look in the China market, the China stock market, right, all these foreign funds only account less than 4% of the total A share outstanding.
Okay, but that was enough to move the prices down.
They're enough to, because they keep selling and all this, right? So that causes the Chinese market to go down, but then it's not as much as compared to the Hong Kong market, because the Hong Kong market there's more foreign investor over there.
Okay.
So the impact you see in the Hong Kong market will be bigger, more volatility, right? So in fact, if you look at the Hang Seng Index, depending on when you compare, if you compare with the first year, the Jan-Feb, there was a huge recovery, right? And from that peak to currently at this time of recording is down about 22%. That is enough to put Hang Seng Index in the bear market again. It has been in the bear market for the last 2 years, right? So since the tech crackdown and then the property crackdown, and then subsequently there was a COVID lockdown here and there, right? So eventually they loosening it up, and this year there was a huge rallies, and then suddenly now it all come back down again.
Okay. A bit of a quite a roller coaster, huh?
Yes. So those who have invested in the Chinese market for the last 3 years or 2 years. I think it's been like
It's been on a ride. It's like
quite a long ride, and it's been quite depressing.
Okay.
Yeah.
Okay. But
And I think the valuation at the point of now, right, is about one standard deviation below the means.
Okay.
Right? Last year was at very maximum pessimism. The valuation is actually at the Asian financial crisis valuation
That
in
was
terms
last
of
year,
the
okay.
PE chart.
Okay.
Yeah, so if you look at the PE during the peak of 2020 lockdown, right? So Chinese market also got sold down, right? And the PE for the Hang Seng Index is about 10 times. And late last year, when people were saying that China is uninvestable, right?
Mm-hmm.
And that was the time where it hit all-time low, right?
Mm-hmm.
And the PE was about 7.5 times. Now it's about 9 times. So you are still looking at huge bear market. People are very scared.
Mm-hmm.
Right, so and they're dumping the shares in any stock that has related to China.
Okay. But do you think it sounds really terrible? I mean,
Yeah.
honestly, it sounds bad. Do you think there's gonna be like a house of cards where everything just falls over, China just goes up in flames, basically? Do you think that could happen, or is it going to be more contained? Yeah, certain industries are going to be hit, like for example, property not going to do so well. What do you think?
So I think is, if you were to look at, I think later Rusmi will explain, like those tech companies, right? They are showing very good result on their first half or the second quarter results, right?
So it's not all that bad. Okay, it depends on which sector you're in, right? So if you invested in property developers, obviously you're gonna get hit. Okay, and especially if their business model are not sustainable and they have been relying on property sales to drive the cash flow and take on a lot of debt. And of course, when the music stops, like now, property cycle is cyclical, right? So and at this stage, property developers who doesn't have rental income, they will have to go through this down cycle, and they might not be able to survive.
So the balance sheet is very important.
Very important,
Yeah,
and
okay.
their business model is also very important. Okay, and those Chinese developer that we brought up 2 years ago, like China Evergrande, Country Garden, and now they are now showing up, right? Because they have too much leverage on their book. At the same time, they are now suffering from the weak business model that they have developed since the day one.
Okay.
Okay, they didn't build a recurring business model.
All right.
Yeah.
So there will be developers that have that as well, and there'll be casualties. Yeah.
But at the same time, if you look at Chinese tech, I think if you look at their first half result for most Chinese tech that have actually reported their result recently, I think Tencent has done pretty well. Okay, their revenue is hitting record high. Okay, it's grown double digit, about I think at 11% on the year-to-year basis. But if you look at the operating profit, it has grown by 30%. Okay,
Wow.
So it's the numbers are coming in, and they are showing you that hey, they can actually stage a comeback since the crackdown, right? And not only Tencent, okay, Alibaba is also showing the same recovery. Their total revenue has grown by double digit, right? But on the profit basis, they also have grown a lot more actually. Okay, more than 40%. Okay, you look at the non-GAAP adjusted basis, and this is across the board actually, like Kuaishou, iQIYI, even Baidu, and I think also Meituan. I think the first half result all have delivered impressive result. But the market are not pricing in at this stage because there's so much fears in the market.
So we're saying there's general fear about what's happening in China, and the
Yes.
property market. Yes, I mean the sector.
That's
That sector
quite weak.
is quite shaky.
Yes.
But then when it comes to the domestic tech titans, they're doing very, very well.
They are doing well.
The domestic consumption is still there.
Yes, even with all the poor economic data that you saw in China, right? So, so some of these companies, I think they have turned out to be quite good. Okay, but some of the developers, like those, especially those Hong Kong based, and they have an operation in China, those are the shrewd one, right? I mean, they know that how to go through down cycle. So they have built their business model right since day one. So these developers typically they will keep their crown jewels, right? Their commercial sides of the business, the retail, and then they will list out. Okay, and then their property development part where they will just do it as a one-off, they will not rely too much on that. Okay, versus those pure Chinese developers that just keep on building, selling, growing bigger,
more debt,
more debt,
more aggressive style.
And now these guys are in trouble because first they got hit by the regulatory crackdown, so they can no longer borrow as much money as they used to be, and then now the slowdown in demand affected them, and that's why they are missing all these bonds payment.
And also all these Hong Kong property developers, right? Even though they have recurring, they are still affected because of the China property thing. So their share price also tanked because of the sentiment, right? People view them as one basket by itself.
Okay,
right?
so I think that's the next question I'm going to ask you guys, because like the China situation, I mean, the China outlook looks bad. It's affecting the whole market.
Yeah.
But the domestic tech looks strong. And now you're saying that the property developers, especially those in Hong Kong, are actually, they're still very resilient.
Their business models are very solid.
Okay.
And they have a solid balance sheet as well. And they are highly unlikely going to get affected, right, by the default that you are seeing across the board, right? Because they have solid leasing income, and with China economy opening up, I think there will be more spending, right? That is driving towards of some of these developers that they own retail malls itself. Okay, so but yet they are also being sold down.
Okay, okay,
and they are still giving dividend.
Okay,
dividends are, some of these are actually giving out a yield as high as 8%, 9%.
Wow.
And they are not REITs.
Oh,
and they are developers, right? But actually, their underlying business is more like leasing out their crown jewels. They are those assets that they own, right? So, but they were all just being sold down because people are just dumping the shares.
So, are you looking at any of these Hong Kong developers at this time?
Have take on this opportunity to bought some of the property developers that are based in Hong Kong, not mentioning any names.
Okay.
Right? Yeah. So this is the time where I think is one of the best time to actually look at them. Okay, because of that fear in that property market, right? And they are good one, right? So you want to look at the good one, but you want to avoid those that are missing your bonds payment, because their underlying business model is just bad.
All right.
Just bad.
So basically, I think what Rusmin trying to say is that now it's very pessimistic in the market right now, right? But because of the pessimism, right, you are able to hunt quality companies at a bargain price right now, at this moment, right?
Which is what every investor is looking for, right? If you are worth your salt, this is what you are waiting for.
So at the end of the day, it's not about like going in and buying stock, but going and look at which are the one that is quality, that are still able to generate cash flow, they are still able to pay the dividend, and look into them. And does the valuation make sense? Is it a screaming buy? In this case, it seems like a screaming buy, right? Good rental, still paying 8-9% yield, and on top of that, there's still upside to the property values and all this, which are not accounted for.
All right. Okay. So I know we're not going to mention any names about these Hong Kong property developers. Some of our paid members do know what we're looking at. But in the case of this, if we're not going to make any recommendations or anything, but just to describe, I mean, just to give an idea of those who are watching, if they're going to do their research, what kind of property developer, what in Hong Kong, right? You're saying that they're cheap and they're great business models. What kind of business model are you looking at if you could describe what they're like? That's why are they so strong despite all this?
Now, when it comes to property business, the first thing first is that you need to understand is the property industry is a cyclical business, right? So if you just keep on relying on selling residential property to investors or home buyers, and then you keep on buying land, just keep repeating the whole process, that will work if the market keep going up. Right, so and then you have a lot of demand. People want to buy property, and then they make money. Everyone happy, right? But now, since the lockdown, that has actually dampened the demand in the Chinese property market, and the prices has come down, right? So that caused investors to be scared, also investing in property. So they stop buying. They stop going to the showroom, and when they stop going to the showroom, these developers, when they build their business model on this kind of business model, are now suffering because they don't have cash flow coming in to pay those bondholders.
Yeah, so that's exactly what's happening.
Correct,
right?
yeah. But the smarter one are those that, they build a mixed development. They have the residential, which will provide traffic to the shopping mall, and then offices. Or then, these offices during lunchtime, where they go, right? They go to the malls that nearby their office, and then they just have the lunch. So that will create a lot of tenant sales. And that's why a lot of Hong Kong property developers, those have gone through many, many down cycles, they know that tough time will come again. And this is now the tough time, right? And they are still generating very stable cash flow because they are just relying on the leasing income that they have collected. They are not relying on property sales, which currently is barely affected because of the weak property sentiment in China.
Okay.
Yeah. So those leasing income are the one that will help the smart property developers to go through this down cycle. And in Hong Kong, there are quite a number of them, right? So and these are the people who have actually gone through many down cycles that Hong Kong has seen. Yeah. So they know how to play this market, right? Versus those who, like China background, if you look at the underlying profit or country garden, I think 90% or 100% of their income comes from property sales and development, right? So and now these guys would definitely be hit. Yeah, so they were the one that also get highlighted by the Chinese government that their business model are flawed. They have too much debt. They can't go through this down cycle. Very difficult.
I think if you've been watching or following our channel for some time, we like to look at businesses or business models that have a lot of recurring
business,
revenue, recurring income, and there's a level of predictability to that.
Yes.
So basically, there's the same thing that's happening now, just in the property sector. You're looking for developers that have this recurring revenue that they can rely on, despite the recession or whatever. And it's predictable. It's going to happen.
And
it's
going
to keep coming
down.
They're being sold down across the market, across the board.
So if you're doing research right now into Hong Kong property developers, these are the kinds of business models that we want to look at. So again, we're not going to mention any names, but some people could be asking right now or saying, "Hey, look, China has been crap for 2 years, and why are you still so why do you still look for opportunities in that market when it's been not the best market to look at? What do you have to say to people like that?
I think it's all about perspective, right? Okay. I mean, if you look at the Hang Seng Index, right, they are traded at one standard deviation below the means, and the valuation is very cheap, right? I think it does not. You don't need to be very smart to know that the market is very cheap right now. Okay, so let me bring you to a story of two stories. Okay, so the first story was, if you look at this gentleman. Which is Sir John Templeton, right? So if you remember Sir John Templeton's story is that when the before the World War happened, when the World War happens, right, he actually borrowed $10,000 from his boss, right, and invest $100 in each for I think about 104 companies, right?
Oh, okay.
And after the war ended, right, 4 years later, right, I think he probably left with 34 companies or something, but his amount, right, of 10,000 quadrupled. Went 4 times. Okay. Then now we bring back to another scenario. Okay, where you look back into the Asian financial crisis. The Asian financial crisis was hit by high leverage, right? And the country that was highly leveraged at the point of time, right, that was very badly hurt, right, is only 3 countries, right, which is your Thailand market, your Indonesia market, and your Korea market. So if you look into your Thailand market, they actually dropped as high as 87.5% from peak to trough, right? And your Indonesia market is about 65.3%, and your Korean market dropped about 75.4%, right? But the next 20 years, these are the markets that are one of the best performing from the trough all the way up. Thailand after that went up about 600%. Indonesia went up about 2,000%, and your Korean market went up about 726.5%, right? And if you were to look at Hang Seng Index at the point of time, they are being hurt also, but they hurt because they are also in the Asian market, so they are being hurt. They also pick to trough drop about 60%, but then they also pick up 300%, right? So those fund managers that invested during the Asian financial crisis at that point of time, right, and they started their fund at that point of time, right, next 20 years, right, their fund performance was like 15 to 23%. Okay, so this brings back to what John Templeton said, the time of maximum pessimism is the best time to buy. So last year was the maximum pessimism because the valuation of Hong Kong, right, was even lower than the Asian financial crisis.
Yeah, right? Because people deeming China as a market that is uninvestable, right?
Uninvestable,
because of the
So if you were to look back, right, at Asian financial crisis and the World War II, right, you will think that John Templeton, or maybe those who invested in the Asian financial crisis, they make a smart move and they make money. But I can tell you, if you are at that point of time, you at that situation, it's a stupid move.
It looks super scary.
It looks scary. It looks stupid, and it's exactly like right now. You look at Hong Kong market, it looks scary. It looks stupid, right?
Now every crisis looks scary.
Okay. So I think the concern is that a lot of the investors they are afraid that the Chinese government will destroy the stock market, right? But if you tell me in the past, I'll probably believe, right? Because in the past, they are much of a closed economy. Okay, but right now, China is different because they have tasted the sweet stuff of getting foreign capitals. And you see their GDP grows significantly, right? Once you upgrade, it's very hard to downgrade already. And moreover, they have grown to a size where they become one of the top 2, or maybe the second largest superpower in the world, right? And in order to maintain sort of like a leadership or what, you need support from other countries. And if you were to destroy foreign capital, right, you won't get support from anybody. I think China don't think that is a smart move to do, right? So I don't think they will destroy the stock market, which is what a lot of people have been speculating about it. Okay, so your job as an investor is not to speculate things, but to really go back into the market, right? So for instance, now people whack the China market, but if you were to look at the China, right, the foreign capital is only 4% or less of the total outstanding share, but the China market I think only dropped about 11%, right?
11%. CSI
But the Hong Kong
300,
market dropped significantly because there's a lot of foreign capitals in the Hong Kong market, and Hong Kong and China, they are always linked. That's why when they run together for the foreign capitals, right? If you go to Hong Kong market, you can see that there's really a lot of quality companies at bargain price. I'm not telling you to be like all in one stock or all in the country, right? Do not do that, because at the end of the day, there's still such thing called Murphy Law. Anything can happen, right?
Anything can go wrong, yeah.
Yeah, in investing, right, it's all about probability, right? You want to go in the probability, you want to size your position properly. You go in, you know there's some bargains, right? You if you're afraid, right, you no need to even buy into Chinese company in Hong Kong market. You can buy into Hong Kong companies in the Hong Kong market, right? Then you reduce your exposure already, because some of the Hong Kong companies in the Hong Kong market, they do not have exposure in the China market.
Okay, but
right?
it's all been dragged down altogether.
They're all being dragged down.
Okay.
They also have exposure in like the rest of the world, but they are being dragged down.
Okay,
right? The valuation. So if you look in like Warren Buffett, right, he don't even all in a stock, right? The maximum I think he goes in one single stocks is about 40%. At the end of the day, investing, right, is a marathon. It's not a sprint, right? If you make your mistake, you still can survive, right?
Yeah.
But if you all in one stock,
that's it.
that's it.
Yeah,
it's very hard for you to survive.
Yeah.
At the end of the day, you cannot survive the whole marathon, right?
So you got to size your Chinese market exposure properly according to your own risk appetite. If you're not comfortable, then don't look at it. Then look at it. Don't watch this video.
So there's also one scenario where you can all in a company.
Really?
One single company.
Okay.
You must have control over the company.
Must have control. Yeah, that's
those
what Buffett does sometimes.
Those people who have control of the company, I know they are 100% of the capital in the company, because you can control. But if you do not have control over the company, you should not all in into that company.
Okay.
Because Murphy Law again.
Okay.
Right?
So I can feel that you're very passionate about this, China Hong Kong thing, because you feel there's an opportunity right now.
Yeah, I think it's a maximum pessimism.
Okay.
You just need a change in perception, because the underlying fundamental. Let's go back to the underlying fundamental. The underlying fundamental of the company in the Hong Kong market, be it the Chinese tech or be it the normal Hong Kong companies, they are still profitable. They are gaining. One of the stock I look at, they are on a circular uptrend, and it's still first half result came out up 19% in terms of profit, increased the dividend up 18%, but they are traded. The yield is about close to about 6 or 7% dividend yield, but they're traded at a low valuation. It does not make sense, and the business is not in China; it's like in US and Europe.
Yeah, I think putting sentiment aside, maybe people who are looking at China more like the macro trend that China is actually facing, right? So China is a huge population, right? So and I think there's been a lot of talks on China unemployment rate on the youth part, where you are seeing, I think 1 in 5 fresh grads in China are not getting jobs. And it's all over the media. Right? People talk about it, and then that caused the panic again. But actually, if you zoom out and look at the whole country unemployment rate, actually it's about at 5%, right? So that isn't as bad as what you see, right? But of course, that youth unemployment is a major concern, because it's the future, right? So that is up to the Chinese CCP to solve that problem, right? And they are now encouraging a lot of private businesses to continue to hire the youth, right? I mean, 2 years ago, they did a massive crackdown. So a lot of Chinese tech started to let go a huge, number of people there, right? Now they're actually hiring back. So this number will likely to be improved, but you don't get to see the number being reported anymore, because they have to take it down, right? So they can't see youth unemployment rate anymore in the future, right? But I just want to focus on the bigger picture, right? And the other things that I think the media has actually been focusing on China is that fertility rate, it's hitting at all-time low, right? At 1.1 or 1.09, right? So, and this is the demographic crisis that China is actually going through, right? So it's a long-term issue that China, of course, has to solve, and a lot of countries has the same problem, right? It's not just China, even Japan as well, right? So, but if you look at the thesis on why I think we entered Chinese market, right, is mainly because there's a huge growing population of middle class group of people that actually coming online. Okay, and this by 2030, I think Boston Consulting is estimating another 80 million, right, of middle and upper class income will join this group. Okay, meaning to say that this 40% of the population, China population, at the end of 2030, they will consist of middle and upper income class group of people. And this group of people are the one that are driving the GDP growth. They are contributing about of it, 80%, 80-20 rule, right? 80% of the Chinese economy. And this is expected to continue to grow, and that will cause the demand to grow, right? And of course, when you have the expenditure growth, usually you see your income growing as well, right? So there's a slightly mid-term growth for Chinese market. Obviously, long-term, the demographic crisis will come into play eventually if they don't solve that crisis. But it's just how the media has actually been describing how bad the situation in China is by focusing on just the bad things, right? But if you look at on the bright side, this growing middle class income group of people is going to spur the demand for a lot of these businesses that we actually invested in China over the midterm to long term.
I think when it comes to the news, it's always the here and now. The perspective is like what's happening now,
Yes, they just zoom in.
And as an investor, you have to kind of like zoom back and have a look at the bigger picture, the details. Yeah. And I remember I was at Temasek Review recently this year as well, and they invest in China as well, Temasek, and they did mention that they invest in China in companies that are fueled by domestic consumption. So because they see the growing middle class, like you said, there's a lot of growth in that area. So if they were to invest in a company, it has to have domestic consumption.
Yes,
it's not reliant on the US or the world. So even if there's this US-China thing going on, they're not as concerned. But back to the point, basically, Hong Kong, China, the valuations are really cheap right now because
if you look at the Chinese tax, a lot of their consumption revenue are actually from the domestic.
It's all local.
So they are not relying on like the trades between the international market like US. I mean, those companies obviously have to be more careful because now there's a tension between US and China. So those companies could get banned, and stuff like that. So I mean, we have seen what happened to Huawei, right? So you try to avoid those companies that have this involved in this tension, political crisis, especially in the semicon space, is a very sensitive area to be in also, right? So you just have to be very tactical when you are entering to the China market, okay? But one thing I just want to end off with, of course, is China is a homogeneous market, right? So just like US, and it's a lot easier for Chinese businesses when they have the proven product or services that seems to be quite good, right? They can actually roll out across the market, right? Of course,
just sweeps the whole country, and it just booms.
But then you attract tons of competitors coming in. Right? So that's the Chinese market. It's a market that everyone loves, but they hate to be in it because it's so competitive. And this Chinese company have getting used to that market. Very tough. Right.
All right. So I think that's a pretty good wrap up. I hope that's a pretty good wrap up of what has been happening in China, because I think the Evergrande crisis thing, all the news is coming up. But we wanted to share, what we think about China or / Hong Kong and the opportunities in those markets. Okay. So it's not about just like you said, going all in. But it's about being tactical, being smart about picking the companies that are going to be resilient and come out of this.
And size your position.
All right. So I hope that was a pretty good wrap up of China and what we're looking at. We feel there are opportunities there, but be smart about them. Okay. So is there anything else you want to share, guys?
That's all.
Happy investing.
Happy
shopping, actually.
Happy shopping. Okay. So my name is Adam Roseman.
Thank you.
Victor, thank you so much for joining us. Any questions about this topic, China or Hong Kong, please put them in the comment section. We'll answer them for you. And of course, if you like this video, please hit the like button and of course subscribe to our channel. Many more roundtables coming up, and we'll see you again.